This US market pullback isn't really about how much Nvidia has fallen. The real thing investors should be watching is US Treasury yields. Because underneath this tech sell-off, something much bigger is happening. The 10-year Treasury yield has climbed back towards 4.6%. And when long-term yields keep rising, markets usually become far less willing to pay extreme valuations for growth and AI stocks. That matters because most of this AI rally has been built on future expectations, future earnings, future demand, future dominance. But the higher interest rates go, the less valuable those future profits become. And AI is already an incredibly expensive industry to fund. Data centers, GPUs, power infrastructure, cooling systems, network expansion, all of it requires enormous capital. So once financing costs rise, markets start asking a very uncomfortable question. Are these AI companies actually worth these valuations? That's why stocks like Nvidia, Micron, and Coherent have started coming under pressure recently. So right now, the key question isn't, is this the dip to buy? It's, when do long-term yields finally peak? Personally, I think investors need to see at least three things before getting aggressive again. First, the 10-year Treasury yield needs to clearly roll over. Second, the Federal Reserve needs to signal that it wants to ease pressure on long-term borrowing costs. And third, AI leaders need to show real institutional buying support after the pullback, not just a one-day bounce. Because if yields keep climbing, many short-term rebounds in tech could simply be technical rallies, not the start of another major bull run. So right now, the most important thing isn't rushing to buy every dip. It's preserving cash and waiting for a higher probability entry point. If you want to know which interest rate signals Wall Street is watching most closely right now, DM me bonds.